Today, why this video? Let us discuss letter of credit. The today's topics are definition of letter of credit, parties involved in LC transaction, issuing bank, advising bank, confirming bank, negotiating bank, and reimbursement bank. Flowchart of entire LC mechanism. Hidden risk in LC process, red flags in LC transaction. Let us think of a manufacturer of shoes in India and a business enterprise in US. The manufacturer of shoes in India intends exporting the products to US, but he is worried whether the firm in USA will make payment after taking delivery of the consignment. The business enterprise in US is interested in importing shoes from India, worried whether the manufacturer in India will maintain the quality and ship the goods as per the schedule. In these circumstances, settlement of trade becomes much easier if a mutually acceptable third party guarantee the payment to the manufacturer, that is exporter, as well as delivery of the merchandise to the buyer, importer. The importer's bank gives an assurance to the exporter that they will make payment on the due date, subject to the condition that the exporter will comply with all the terms and conditions agreed upon between the importer and exporter. One international trade transaction sometimes involves 5 different banks. What is meant by a letter of credit? An assurance given by the buyer's bank on behalf of a customer to the seller, guaranteeing payment of the bills drawn by the seller on due date, provided the seller has complied with the conditions specified in the letter of credit. Let us now see the parties involved in an LC transaction. The first one is the opener or applicant, that is the buyer, importer. Opening bank, issuing bank, buyer's bank, that is importer's bank. Beneficiary, the seller or the exporter. Advising bank, located in the exporter's country, the bank which verifies the authenticity of LC, does not give payment guarantee. Confirming bank, a bank in the seller's country that adds guarantee to the LC, adds its own payment guarantee to the LC. Exporter then has two banks guaranteeing payment. Negotiating bank, the bank which advances money to the seller. It purchases or discounts the export bill and pays the exporter after examining export documents if the documents comply with the LC terms. Reimbursing bank, issuing bank's correspondent which settles the claim of the negotiating bank appointed by the issuing bank, reimburses the negotiating bank for the amount paid to the exporter. Importer approaches his banker with a purchase agreement and pro forma invoice and requesting for issuance of an LC. Importer's bank issues the LC. He is the issuing bank. The LC issued by the importer's bank will be transmitted to the exporter or to his bank. The exporter may not be able to verify the authenticity of the LC. The seller's bank or any other bank in seller's country will verify the authenticity of the LC and confirms the same to the exporter. This process of verification of authenticity of LC and conveying the same to the seller is known as advising LC. Process of advising LC. LCs are opened electronically through SWIFT. The advising bank will print the SWIFT message, put its rubber stamp and reference number on the LC and send it to the seller under a covering letter which will be signed by an official of the bank. Confirming bank. At times, the seller not being sure of the financial standing of the buyer's bank may insist on a bank in his country adding their guarantee to the LC. This is known as confirming the LC. A bank in the seller's country confirms that the LC issuing bank will honor the commitment, and if they do not do so, the confirming bank will meet the obligation. The bank which adds its guarantee to the LC is known as confirming bank. Why exporters love confirmed LC? With a confirmed LC, two banks stand behind the payment. Negotiating bank. After receipt of LC and getting the LC advised and confirmed, the exporter will approach a bank with the LC and may seek pre-shipment credit facility to manufacture the products. Since the issuing bank has guaranteed payment of bills drawn under the LC, any bank will be happy to give an advance against the LC. The exporter will produce the goods and move the goods to the seaport or airport. Once the goods are cleared by customs department, the exporter will move the goods to the shipping agent and obtains the bill of lading. Bill of lading is nothing but the freight receipt. The exporter then submits the documents such as copies of customs clearance certificate, bill of lading, invoice, transit insurance papers, etc. mentioned in the LC along with the printout of the LC to his bank. The bank which had extended the pre-shipment credit facility to the exporter after the checking the documents and satisfying itself that all the conditions of LC have been complied with will discount the bill, that is, grant post-shipment credit facility. The bank will recover the loan outstanding in the pre-shipment credit facility from the post-shipment credit facility. Discounting a bill accompanied by an LC is known as negotiation of the bill. The bank which negotiates a bill under an LC is known as the negotiating bank. Negotiating bank will give proof of shipment to the LC issuing bank. Normally, it will be mentioned in the LC that if any bank negotiates the bill under LC, they can claim the amount from the issuing bank electronically. Issuing bank will collect the amount of the bill from the importer and will give him the proof of shipping. Issuing bank will make payment to the negotiating bank or exporter's bank and collects the shipping documents. The role of reimbursement bank. It is possible that a bank has issued an LC in the currency of another country. For instance, an Indian bank has issued an LC in US dollars. Naturally, the negotiating bank has to be paid in USD, which can be done by a bank in USA. The Indian bank will instruct in the LC that the reimbursement claims have to be sent to their correspondent in the USA, whom they would have instructed separately to honor such claims. The bank from which reimbursement is to be claimed is called the reimbursement bank. In this case, the correspondent bank will make the payment to the negotiating bank and collects the amount from the issuing bank. Once the importer makes the payment to the issuing bank, buyer gets a shipping document, he hands over the shipping documents to the shipper and collects the goods. Remember, issuing bank gives the promise. Negotiating bank converts documents into money. Remember, many people think a letter of credit guarantees the goods. LC guarantees payment for documents, not the quality of goods. Banks deal only with documents, not with goods. In LC operations, documents are everything. In LC business, accuracy is more valuable than speed. Site LC pays today, usance LC pays after time. Three most common LC discrepancies. Do you know most export documents are rejected for just three simple mistakes? One, late shipment. Two, invoice mismatch. Three, missing documents. Remember, in LC business, small document mistakes can block big payments. A letter of credit is considered a safe trade finance instrument. Bankers must remember that several hidden risks exist in the LC process. A good credit officer should be able to identify these risks quickly. 1. Importer credit risk. The importer may fail to reimburse the issuing bank after documents are honored. If the bank has already paid under the LC, it must recover from the importer. Bankers focus, assess importers' financial strength and credit limits before opening LC. 2. Issuing bank risk. The issuing bank itself may default or face liquidity problem. Example, if the issuing bank is financially weak, the exporter may demand confirmation from another bank. 3. Country risk. Political instability, sanctions, or foreign exchange restrictions may prevent payment. Example, war, currency controls, or government restrictions in the importer's country. 4. Document discrepancy risk. Documents presented may not comply with the LC terms. Common discrepancies are late shipment, invoice mismatch, missing document, incorrect bill of lading. Banks may refuse payment if discrepancies exist. Fraud risk. Documents may be forged or manipulated. Goods may not actually exist. Since banks deal only with the document, fraud risk always exists. 6. Exchange rate risk. Currency fluctuations may affect importer or exporter obligations, especially in usance LC transactions. 7. Goods but performance risk. The quality or quantity of goods may not match expectations. However, remember the golden rule of LC. Banks deal with documents, not with the goods. And LC reduces trade risk, but it never eliminates bankers' risk. So, in the LC business, document fraud is a real danger. 10 red flags in LC transactions every banker must watch. These warning signals help bankers detect fraud, abnormal trade behavior, or hidden credit risk in LC transactions. 1. Unusual trade value. LC amount much higher than the normal turnover of the importer. Sudden jump in transaction value. Risk. Possible over invoicing or trade fraud. 2. New importer or exporter relationship. Buyer and seller have no previous trade history. Risk. Higher chance of collusion or fraudulent trade. 3. Commodity outside customers' normal business. Importer dealing in goods unrelated to his line of activity. For example, a textile trader suddenly importing electronics items. 4. High risk country involvement. Trade involving politically unstable or sanctioned countries. Risk. Country risk, payment restrictions, compliance issues. 5. Complex or unnecessary routing. Goods shipped through multiple countries without clear reasons. Risk, possible trade-based money laundering, TBML. 6. Repeated document discrepancies. Same exporter repeatedly submitting incorrect or inconsistent document. Risk, possible document manipulation or lack of genuine trade. 7. Unusual shipping terms, very short shipment period or unrealistic delivery conditions. Risk indicates non-genuine trade or paper transactions. 8. Related party transactions. Importer and exporter are related entities or same ownership groups. Risk possible round tripping or capital flight. 9. Excessive use of usance LCs. Importer frequently opening long credit period LCs 180 to 360 days. Risk using LC as indirect financing rather than trade payment. 10. Large LCs with weak financials. Importer requesting high value LCs despite weak balance sheet. Risk bank ultimately exposed to credit default. When trade looks unusual, bankers must investigate before issuing the LC. Thank you all. I shall come out with such small videos on lending topics. Subscribe to my channel NP IER's Learning Modules in Lending and click the like button which enables you to get notifications whenever a video of mine is uploaded. Follow me on Facebook and on Instagram.